Why all the fuss recently in the financial press about the growth of index investing? A graphic can help illustrate the popularized differences between traditional active management and index or so-called passive management. The vertical axis represents how long a security is held in a portfolio, from less than a second, for example high-frequency trading, to forever, buy and eternally hold. The horizontal axis describes how many securities are held in the portfolio at one time. At one extreme, a portfolio holds only one security, say shares of Apple stock. On the other end of the spectrum, the portfolio holds shares of every security available to the public around the globe, maximum diversification. Active management is generally portrayed as existing somewhere in quadrant 3, where portfolios hold a few carefully selected securities for a relatively short time, sometime less than forever. Index or passive management is often pictured in quadrant 2, with a portfolio of many securities held for a very long time. Of course, both of these definitions are virtually of no help due to their generality. Informed investors need to know more. An actively managed portfolio can be run by a person or an algorithm with the goal of beating a benchmark. Usually the benchmark is an index. You can see where this is going. An index is a list of securities with something in common, usually created by an investment research entity or publisher. For example, the S&P 500 index is published by Standard & Poor's. If you own an index fund based on the S&P 500, you will own S&P's current list until they release their annually updated, so-called reconstituted list. By the way, there are hundreds of indexes focusing on different groups of securities. Then the contest begins. The active managers go about selecting, buying, and selling, while the index publisher tracks the performance of its list. At the end of the quarter or the year or the 5 years, performance numbers are compared to see who won. So what sounds like the most plausible way to win as an investor? A portfolio where a few carefully selected securities are alternately bought and sold, or a portfolio where a publisher creates a list of securities that are held until the publisher updates the list? What if there was a better way to invest, one that is neither traditionally active nor dependent on the timeliness of a publisher? Rather than limiting the discussion and your portfolio to A or B, what if the better science indicated a choice C?